What's up, guys? Today we're talking about preparing for the bear market, taking profits with yield farming, and a few mistakes that I've made during the last cycle so that you can avoid the same mistakes. In this video, I will go over my own strategy of taking profits and how I plan to exit the market into the coming weeks and months as the price moves higher. If you guys are new here, my name is Richard. I'm a yield farmer and investor. And here's a quick portfolio update. You can see my main Ethereum positions are doing quite well, still sitting in 8.4 ETH profit. The close position stays the same at 8.6 ETH. And a lot of these pools are actually generating really good APR here, mostly between 25 to 75% APR. But because the market has been drifting upwards, I'm now more focused on stacking more US dollar profits rather than Ethereum profit here. For example, this USDC to Ethereum pool that I'm currently in is trying to profit from the ETH price appreciation. I'm slowly selling my Ethereum to USDC in this case, and depending on how the charts look, I might exit this position completely as well. Yield farming is a really great way to grow your portfolio, accumulate assets, and generate a passive income, but there's a lot of things to learn. That's why I started this channel. So let's dive right into the video. But again, none of this is financial advice. I'm not your financial advisor. I'm just sharing what have worked for me, as well as my mistakes. So hopefully you can get some value out of that. So in the last cycle, if we were looking at Ethereum and Bitcoin here, there were a few mistakes that I've made. The first one is just not thinking long-term enough. I was a little bit panicking because I held a lot of Ethereum. I came from the NFT world. When I first started crypto, the only exposure I had was Ethereum, and I still continue to have a lot of Ethereum here because my cost basis is lower as I'm trying to accumulate more and more Bitcoin. But the main mistake is just not having enough stablecoin and cash to buy the dip. When the prices was trading at $1,000 or below $2,000, I simply did not have enough cash to buy a lot of the dip, and I wasn't thinking long-term enough about these projects. A lot of people were gone. The market feels dead. And it was my first cycle, right? I didn't know that that was actually the best time to start accumulating more and more assets rather than waiting for, the bull run to kickstart again and when everyone is coming back. So that's the first mistake I made. But thankfully, I also made some nice gains during that period, farming different airdrops and still flipping and trading some NFTs. I was still able to accumulate a nice stack of Ethereum heading into the current market. But really, when the market is really quiet, it's actually the best time to do your research and actually position yourself so that when the market recovers, the activity comes back, the liquidity comes back, you can start taking your profits and selling out of your position, decreasing the risk. And this is exactly what I did a couple months back when Ethereum's price started trending down. The market becomes quieter and quieter. I did a bunch of work and research, positioned myself, and then when the market rips back up again, as I made some ETH profit, my portfolio rockets back up much higher than a lot of other people's portfolio because I put in the work and positioned myself properly, right? If you guys look at my current liquid portfolio, it's sitting at 210K, which is really good considering that Ethereum is still at 3622 when it was trading at its local high where Ethereum is at $4,000. And one of my core holding, which is Pixel here, was trading at 10 cents. My portfolio was actually lower than this. It was around 180K back in January. So clearly implementing yield farming and asset accumulation strategies was able to allow my portfolio to grow really quickly when the market bounces, right? And that's the same exact strategy that I would be implementing if we see a huge correction here. If Ethereum went up to $10,000, for example, I take a lot of profits, and then when the market pulls back, I would be focusing mainly on asset accumulation. So now I will be sharing 3 different yield farming strategies that I will be implementing as the prices move up to decrease my risk and hopefully balance my portfolio a little bit. When the prices move down, I could take advantage of the cheap price again, right? The first thing I personally will be doing is stacking more stablecoin more aggressively. The more the prices move up, the more stablecoin allocation I want to have because that's when the prices are overheated. When the market is really strong, that's when I want to be taking my profits, especially on altcoins, right? We know that altcoins are very volatile, and some altcoins might not even make it to the next cycle, right? So we really need to be more diligent when it comes to profit taking. And the way I like to look at it is the prices are sitting in different zones. Currently, Ethereum is sitting around $3,000 to $4,000 zone. So in this zone, I'm not really going to sell all of my assets, right? Especially if we drop down to the weekly chart. It seems like Ethereum is going to test this $4,000 zone. It's the fourth time in this cycle to test the zone. So I assign a pretty high likelihood that this zone is going to be broken eventually, especially with the inflow that we're seeing from the ETFs. We're seeing a couple hundred million per day of inflow. So really that's adding the buy pressure to Ethereum. And I think a lot of people might be waiting to basically short the market at $4,000, especially for Ethereum. But in my opinion, they would just get liquidated and the price would just go up higher. But at the same time, like I've said, I started using more USDC and Ethereum pool to basically dollar cost average out of my exits. You can see my ranges are pretty wide here from $2,300 to $100,000. I don't expect Ethereum by the end of the year is going to dip much below 2,300. That's why I set these ranges here. And as Ethereum's price move up pretty aggressively, I would be able to take more and more profits. So that's the first zone I'm looking at. And then the next zone is really critical in my opinion, is the $4,000 to $5,000 zone. So if Ethereum is able to trade in this area and eventually break out, we could still see a huge run up because $4,000 to $5,000 was near its previous all-time high. This is a crucial zone to watch for. But again, I'm not going to try to time the perfect top, right? Even now, I'm stacking stablecoins. Every single month when I harvest fees, I'm stacking more and more stablecoins more aggressively. For example, this month, I would probably sell most of my fees into stablecoins, maybe 50 to even 80% of my fees. Normally, I would just use those fees to buy Ethereum and Bitcoin. But because I want to hedge my downside, I want to stack more and more stablecoins. And if we do see a bad market condition again, I could be deploying my stablecoins once again. But really, my actual target for Ethereum this cycle is around $10,000. That's still a pretty conservative target in my opinion, with the ETF inflow and the institutional adoption that we're seeing. But for me personally, I'm not going to be applying any short to Ethereum unless the prices are starting to flash some topping signals, especially on higher time frame charts, and the prices are between this $5,000 to $10,000 zone. If I do add a short or different hedges, I'm not going to do it very heavily in this $4,000 to $5,000 zone. I might start with a little bit of a short if I want to short Ethereum to protect the drawdown. But if the prices move higher, I want to be sure to capture the profit and then add to my short to basically position myself for the bear market. So that's the second strategy that I would be implementing, right? The first is stacking the stablecoin. The second is adding shorts or buying different options to protect my portfolio. One simple way to add shorts to your portfolio is, let's say you're now 50% into stablecoins when the market is really hot. Let's say Ethereum is at $8,000 to $10,000 here. We stabled up a lot of our asset. We don't have to short if we don't want to, but I could use some short to balance my Ethereum exposure. If I'm still sitting in mostly Ethereum pairs here, like these Bonk and ETH pool, Pixel to ETH, Pendle to ETH, then most likely the asset that I will be shorting is Ethereum, because a lot of times if Ethereum doesn't do well, those other altcoins are not going to do well as well. And I don't really like shorting smaller cap altcoins for a hedge, simply because they could drift up higher. And if there's a asset specific catalyst, it could easily liquidate me. And it's just much more management, right? So what I want to do instead is just focus on Ethereum here. If the monthly RSI reaches like 70, for example, I personally use the 25 period RSI to remove some of the noise. And then if we see the MACD, the histogram, seeing a huge green valley up, and then it's starting to basically shift from like a dark green to a light green, that's when I would be a little bit worried and then maybe scaling into my shorts or taking profits even more aggressively. But here the monthly chart looks good. If we wait for a couple months, I still expect the prices to move much higher than we are seeing, unless something really bad happens to the market and there are other catalysts that come into play. So that's one way, right? Let's say you're 50-50, 50 in crypto, 50% in stablecoins. I use that 50% stablecoins on different perps platform to short the market, either with like a 1-to-1 ratio so that I'm basically close to delta neutral, or with a partial hedge, maybe half of the crypto portfolio, right? Let's say I have like a 50 Ethereum exposure, then I might open like a 25 Ethereum short using the stablecoins as a collateral. So if the prices do drift higher, I would still make money, and it's not as likely to be liquidated, especially if Ethereum is trading at $10,000, right? And basically, if the prices do draw down, I could take profits on those shorts and then flip long again to buy those assets at a cheap price. What I want to show you guys as well is that we can buy different put options to hedge our downside for Ethereum. So what a put option is basically is that it allows you to sell the asset at a particular price when the prices drop, right? For example, if I buy a ETH option at $3,500, when the option expires, if Ethereum is trading at $3,000, for example, then I would make $500, right? Minus the option premium that I'm paying. In this case is 0.5, but this option expires in 6 hours, right? So it's not very likely that Ethereum is going to crash below 3,500 in the next 6 hours here. So what I typically like to do is look like at least 2 weeks in advance or 1 to 3 months in advance and kind of look at the different rates. And what I can do is take on this APR value. And if I want to go roughly 2 weeks in the future, I could be looking at this August 1st or August 8th contract. And you can see the future price is trading at 36.26. But if I buy the put option to be really close to the current price, it's going to be much more expensive. You can see this is like worth 100% APR if you analyze the price. So if I'm using the fees to buy some put options, I'm sacrificing this APR, which could be too much, right? So maybe I don't want to sacrifice 100% APR. If my portfolio is pulling a 50% APR, maybe I take that 25% to buy this $3,100 option contract, right? And you can see with every contract, I would be paying this $48.4, $48.8 here. So if I were to buy 10 Ethereum worth of put options, it means that at $3,100, I would be break even. But let's say Ethereum drops to $3,000 when the contract expires here in 19 days. With one contract, I'm going to be making $100, right? Minus this option premium here of $48 that I'm paying. So when I first buy the option is going to be worth more. If Ethereum crashes to 2,500, for example, and I just bought the contract, I would actually make a lot of money because I could sell the option contract to other people. You can see these other put options that are in the money and trading above the current price is trading at a really high premium, right? So if Ethereum crashes to 2,500 or to $2,000, I would be able to sell this $50 contract for much higher than its current price. But here I want to show you guys this. If the option expires, you can see I would only be profitable under this 30.51 mark, right? Because I will be paying $48, $49 to buy the contract. So the prices do need to dip below that to be able to make a profit from it from a hedging standpoint. So that's a really cheap way to hedge your positions. For example, I buy 10 Ethereum worth of this option contract to protect the downside of my portfolio for the next 19, 20 days here, and it will only cost me $400 something. If the prices do trade above 3,100 when the option contract expires, you're not really going to make any money, right? Unless the price dumps really hard and you just bought the contract, let's say it's at 3,100, then you can sell the contract to other people. But if not, then you're not going to make any money here in this case. So really the best way to use option contract is to protect against the worst case scenarios. Let's say I want to buy a further out contract. You can see here it expires 68 days from now. Because it takes more time to expire, the price would be higher, but you can see the APR is actually lower. So to buy a option contract at $3,000, I would only have to sacrifice 20% of my APR, right? If I buy one option contract for Ethereum, it's worth $134. And if before the expiration date, Ethereum drops to like $2,000, for example, I would be making this $1,000 profit from this option contract if I buy at 3,000, right? 3,000 minus 2,000 is a $1,000 profit. But I also paid this $135 initially. So my net profit is $800 something. And because we're cash flowing a lot with our pools, then buying these option contracts every single month to protect our portfolio when the prices are really high could be a good way to protect against the drawdown. And the third strategy that I want to share with you guys is using a risk hopping strategy. If you guys go back to my previous videos when the prices are cheap, I basically mentioned that I've increased my risk by being fully into crypto to crypto pairs to accumulate more crypto and Ethereum because during that time prices were just trending down, but a lot of different assets are still outperforming or underperforming each other, right? If we look at the Pendle chart, for example, you can see Pendle to Ethereum. I've recently just re-entered into this pool, but during the last few months, you can see a period of Pendle underperformance and then Pendle outperformed Ethereum. And by basically entering at a cheaper price, and then when the prices do recover, I could take profits into Ethereum because I suffer in Ethereum positive divergence loss, right? Which means that whatever asset that I bought in my initial entry is getting sold to Ethereum at a higher and higher price that's above my entry. So then my liquidity pool is always going to be sitting in profit if the prices are above. And then when I take profits, I make a net Ethereum gain. This is how I've been able to generate a lot of Ethereum and make a lot of money in the process. But my point is there are a lot of these opportunities available when the Ethereum US dollar price or the crypto US dollar price is trending down. You can see that was like a pretty aggressive downtrend here. So then I really don't want to be in a lot of crypto to stable pool at that point, right? Because what's going to happen is if Ethereum rips back up, which it did, your crypto is going to be converted to stablecoin at a very rapid pace, especially if you guys run tight range strategies. I see a lot of strategy that are setting like their ranges based on the daily chart, and the ranges are just simply too tight. You're going to miss the bulk of the move here if you're trying to squeeze the APR. For example, some people were squeezing this $3,000 to this $2,200 range here using different indicators like Bollinger Bands or whatever bands. You simply will just miss the move, right? So that was like pretty high on the risk curve here, especially if you guys were yield farming mid to low cap alts. But as the market gets overheated, people take on more risk. I actually want to do the opposite by hopping down to lower risk investment like crypto to stable pool because we're pairing stable coins with assets like Ethereum. If Ethereum draws down, my USDC or USDT is going to be slowly converted to Ethereum, but that process could be slower or faster depending on the ranges you set. So if I set a really wide range, for example, then my portfolio drawdown would be really small compared to tight range strategies or people that were in fully crypto to crypto pools. If Ethereum goes up to $10,000, I definitely do not want to be fully in crypto to crypto pools unless they are assets that I am basically willing to hold down through the drawdown and through the bear market. And those assets could be stuff like Ethereum to wrap Bitcoin or even Ethereum to Solana. If I want to still accumulate those assets into the bear market, I could keep some exposure to that. But a lot of mid to small cap tokens, we do have to cut our losses or take profits if the market is really overheated and a potential bear market is on the horizon. And again, we're just swapping from like crypto to crypto pools into more crypto to stable pools, and then eventually maybe mostly into stable coins as well. And I call this strategy cycling. When the prices are oversold, we're in mostly crypto to crypto pools. When the prices recover, I'm transitioning more and more into crypto to stable pools. I don't really want to add too much exposure to the crypto to crypto pools in this case because the prices are already trending up and potentially a drawdown is coming. And if the prices really heat up, then I could be mostly in stablecoin strategies as well. But as a longer term investor, I'm looking 5 to 15 years down the line. I don't really want to be like 90% into stablecoins in case the market just drifts higher. So I'm personally targeting a 25 to 75% allocation, but most likely going with a 50% max allocation. If I want to have more stablecoins, I might just sell the fees that I'm earning to keep de-risking, or just short the market a little bit and then buy some put options to protect against the drawdown. So those are the three main things there. The first is making sure that we're stacking more and more stablecoins on the way up, taking profits with the fees and taking profits with our positions. The second is using different hedging strategies. Like if you're 50% into stablecoins, you could consider adding shorts to the market or buying different put options as you're earning the fees to hedge the downside. And then lastly, we want to focus mainly on crypto to stable pairs. If the prices are high and even lower cap crypto to stable pairs, it could still work really well. If the prices drifts higher, if I'm in ETH to USDC, for example, I would still make a lot of US dollar profit, especially as a wider range LP, right? And then I have another bonus tip for you guys is to actually focus on increasing your active income. It's always good to do that. If you have a solid base of income, for example, if you're making, 10K a month, then it's going to be much easier to make a profit during the bear market because you could be buying a lot of asset for cheap when everyone else doesn't have money, right? So that's one of the things that I'm working on as well to increase my active income as much as possible because a lot of yield farming strategies are relatively passive, especially if you guys stick to wider ranges like I do. We still generate really good APR and we get much more asset appreciation compared to tight range strategies. And we also have the extra time that we could use to basically focus on increasing our income so that when drawdowns do happen, we could add a lot of our assets to the portfolio. And then when the market recovers by 2x, 3x, we would be able to grow our portfolio really quickly. And if you guys want to learn more about yield farming, be sure to look at other videos on my channel. I go into pretty detail here in each video and try to give you guys the most value I can. Thank you once again for watching. I'll catch you guys next time.